Hello, welcome back, and today we're going to be talking about realistic targets, what our goals are in our trading day to day, month to month. It's important to have targets set up in your trading. It's a goal that you have to achieve, and when you achieve it, you pat yourself in the back. And it's always important to have this little vision of where you want to get month to month, year to year. If you don't have that vision or the number specified, your goals are very up in the air and not solidified. So one of the things to do is have your monthly target set. You'll figure this out when you put your numbers into my money management software. You'll have your monthly pips, and that will stay the same, but what will change as your account balance changes will be the dollar profit that you take month in, month out. So as this account increases from 500 to 1000 over time, you'll notice $50 profit, and then when it doubles it's up to 100. It's simple, but the pips were still the same. Why is that? Because the position sizing changes as your account increases, okay? But monthly pip targets are very important, and what you should expect from the markets. Now, a lot of people will always tell you, or you'll see when they're selling things on papers and on websites and whatnot, that you can easily snatch 600 pips to 1000 pips from the market month after month. Okay, that's a myth. It's a load of bull. It's not realistic. I'm not saying it can't be done. It definitely can be done, but to achieve this month in, month out on a consistent basis is very, very unlikely. Okay, if you have too high expectations, you're going to feel let down every month. If you're aiming for 600 and you're only getting 400, you're going to feel deflated and you're not doing a good job. So it's important to have lower your goal and get that sense of achievement out every month. You know, the targets have to be realistic, okay, and achievable. So let's talk about this 600 pip philosophy. On this Euro chart here, it's a daily, and let's just say, I'm not saying that this is a trading system here, this is just a quick template that I put up. Let's just say you were trading here on this candle right here on the 3rd of the 7th. Let's just say you got a sell signal and then 30 trading days later, buying this candle that's just kind of pierced above there. That's 190 pips from here to here, and that is 20 trading days. Okay, that's a full month's trading. Okay, and that only gave you 190 pips. Now that is a daily chart. You could go down to a 4-hour chart, although the big move was the same. You could be picking up smaller moves. If you sold here, you would have made a move. If you sold there, you would have made the move. Take your profit, sell again. Because of this up and down motion, you can collect more pips than as opposed to the daily chart moves, because we're in, we're out, we're in, we're out. But still, 600 pips is a lot. It's too much, and accomplishing monthly will probably not happen in a day trading with full leverage positions. So we as day traders probably won't get that. You might get it as if you're a scalper with a different size leverage, if you're less in leverage, you collect more pips. You might have this little system where you're just snatching 5-10 pips, 20 trades a day at a lower leverage. You might be able to collect 600 pips, no problem, but the leverage is a lot lower, and they still might only be getting 10% profit throughout the month. All depends on trading systems and who chooses how to trade what. Okay, but you can collect more pips on the smaller time frames, but it is very noisy and very volatile on here. Okay. So the market moves in a cyclical nature, from trending to sideways to nowhere. To pull out 600 pips from a sideways market is hard to accomplish. We do not know the true tops and true bottoms of moves. We only try to catch the middle 1/3 of a move. What's the middle 1/3? Okay. Instead of trying to catch the very, very top, sell at the very bottom, what we do is, when you got the trend lines in, and then let's just say you place a trade on the sell, and then you bought back on this break. That's the middle 1/3 right there, from here to there. Okay, we're not trying to sell here and buy there. That's just not achievable. Okay, we always collect the middle 1/3 of a trend. That's good enough for everybody. The profit we take from these moves will easily achieve a 200 pips per month profit target, which is 20% our full leverage, which we'll go through later, and which is an accomplishment by itself. Increasing your account balance by 20% month in, month out is accomplishment. It's a good thing to do, and when you compound that over the full year, it's a very, very good thing to have done for yourself. 20% monthly compounded can grow to an excellent amount month in, month out. So we don't actually have to capture a lot of pips to benefit from a dramatic increase in our account balance. 1 to 200 pips monthly is all we need. Okay, so I set a maximum of 200 pips monthly. Okay, and that might be at my full leverage positions, which we'll talk about, or it might be just half the positions. I won't try to capture 400 pips from the market, because I know that's not achievable. No matter what leverage I set myself in trading my position sizes, it's always 200 pips. Okay, nothing changes about that. I recommend you do the same, set that, because the market actually moves in a cyclical nature. Like we said, winning streaks usually turn into losing streaks, because for a particular system, one thing might be going your way month in, month out, and then it will decide to change the trend, and then all of a sudden your trend following system stops working now. So that's why when we collect the pips after the month, we tend to stay out, be happy with your profits, stay at the market, let it do its thing, let it change its course, and we come back in at the start of the month fresh headed, as everybody else does. Because at the end of the month, the market conditions change as well, because a lot of traders in the financial institutions work by this monthly calendar of profit or losses. When they've made their profit, they'll exit their trades, and they'll stay out of the market because they don't want to start making some losses and then have to present it to the bosses after making winning trades, and then have to present losing. So what they do is, if it comes to the end of the month, they won't make any more trades. So you will notice at the end of the month the market actually starts to slow down. This is because there's less money in the market, because all the institutions are doing the exact same thing. Now you might not notice any trend changing atmospheres, you'll just notice a loss of volatility and the markets will start to sway about with no clear direction. Okay, so these are market cycles. They're all based month in, month out. Same goes for the end of the year, different times of year, holidays, summertime when everybody's out trying to enjoy the sunny weather. There'll be less money in the markets because they're all getting tied up with being on holidays and trying to see their family before they have to get back to work and whatnot. So there are all these cycles. So when you start your month, have your target 200 pips maximum. Once you've made it, get out, stay out, be happy, go and enjoy yourself like the rest of the people. The last thing you want to be doing is being in the market with the desperate losers that haven't made a profit. These guys are going to be very irrational, just trying to snatch any kind of pips, using their emotions to trade from, okay, because they haven't made their profits already, so they're desperately trying to claw it back, okay, so they're trying to whip trades out of everything. So the market usually becomes unpredictable, especially with the lower volatility, because there's nobody in the market anymore, because they're kicking back on the beach. Alright, so that's why we stay out. So let's talk about 100 pips profit at the end of the month. This is only 5 pips a day, by the way, just to point this one out. This is how simple it is, okay? 5 pips a day over a 20-day trading period, that's Monday to Friday, is 100 pips, which is 10% at full leverage, and 200 pips per month is just 10 pips a day, which is a 20% increase on your balance. So these are very, very small numbers, but because we're trading at high leverage, they actually increase and can also decrease the size of your balance at the same time. But if you play your cards right, you do things well, you have things on the positive side, then you will notice some differences, and you'll be well on the road to achievement, as long as you can maintain your trading style and emotions. So you need to go and think about what your expectations are, what you think you should achieve from the markets, what your dollar amounts are. Good thing is get that spreadsheet off me. It's my Forex Money Manager, and come up with what you need month in, month out from the trading. You might only need £100 a month, you might need 1,000, you might need £2,000 a month. These are all individual figures, down to yourself to make that decision what you actually need, based over what kind of period are you going to build this money up. You might give yourself 2 years of trading to build your account balance up to a certain amount of money. Let's just say if it's a $10,000 account, let's punch this in. $10,000, trading at 10-to-1 leverage, which is my full leverage, risking 3% on a mini account. Monthly profit target 20%, aka 200 pips per month. Okay, so with this current balance of $10,000, my full position size will be 10 mini lots. Half position sizes will be 5 mini lots. Now what this will do is give me a $2,000 increase at the end of the month if I make 20% profit. Okay, a daily profit target of $100, and monthly pip target always the same at 200 pips, and the daily pip target, it's only 10 pips a day. Okay, change this to 20,000, still 200 pips, and still 10 pips a day. It's just your dollar amount changes. Okay, so if you become consistent, you're getting 10 pips a day, 200 pips per month. Okay, and as long as you can capture those pips daily, you'll get your dollar amount daily and your monthly amount every month, and you can start thinking about getting out your job. supplement your income to pay for your luxuries. But the key is becoming consistent and getting these daily PIP targets down, weekly PIP targets, monthly PIP targets. Okay, it's all about being consistent and having the right system to achieve those targets. Okay, so key information: don't get greedy. Being greedy would be trying to get 600 pips out of the market. That's plain greedy, that is. So set a nice conservative target. If you're starting out, if you're not too sure, set a 100 pips target on your trading. You should be able to accomplish that. That's 25 pips a week. Now that's still going to be a 10% increase if you potentially get all your trades right, and you'll see on the next video what a 10% per month can actually do to your account if you compound it. I'm going to introduce compound to you. It's the 8th wonder of the world, according to Albert Einstein, and as soon as I came across it, it was like a little light bulb just went off my head, and it can show you the power of trading and over time how things can really excel massively in your favour as long as you get things right. Okay, and it's all about having longevity in the market. By doing that, you need to stay alive in the market, which means you always need to have money in your account to maintain this. So we always trade safely, trade with the amounts of money that we can risk and lose if needs be, because not every trade works out. As long as you trade safely, manage your money, collect your daily pips, you should be on the road to success over a few years' time. But it does take time, but maintain it, keep pushing at it, keep learning, and you should get there. So, but it's important to keep these monthly targets set. Okay, don't trade after you've made them. Keep your money, be happy, and don't set your targets too high, please. Okay, so we're going to talk about compounding next, which is a very interesting topic, and let's see what it can actually do to our accounts on the next video. See you then.